Let's hear it from no other than Jim Rickards as he dives deep into the challenges faced by central banks. Now we're faced with another issue, a far more terrifying one, and it's a central banker's most horrific nightmare. Rickards discusses the Fed's blunders, such as raising rates too swiftly and excessively, among other things. Although the Fed has consistently stated, "We're not troubled by inflation. We dislike it, but we understand how to eliminate it. All we need to do is increase rates." They may have to increase them for a longer period and more than people anticipate, and yes, it might get painful. There will be costs involved. However, they can suppress inflation just by increasing rates. They're clueless about halting deflation. How can deflation be prevented? You can't increase rates. It'll worsen the situation. You can bring it down to zero, but once you're at zero, you're stuck there. QE doesn't yield any results, by the way. It's already been tested with nearly $1 trillion, but empirical data reveals that it's ineffective. They attempt QE by purchasing bonds from banks, and the banks return the money to the Fed as excess reserves. This money doesn't circulate in the economy, so what good does it serve? The answer is, it doesn't. So, you can lower rates to zero, but you're trapped there. Is it possible to have negative interest rates? Theoretically, yes. It's been tried in Europe, Switzerland and Japan, but there's no proof that it stimulated any growth. They did try it, but it came off as an experiment that failed. The issue with deflation is that there's no action a central bank can take, and it tends to escalate, making it even worse. And that is a central banker's worst nightmare. However, a quick footnote, we did see this in the 1930s. Between 1929 and 1933, during the first phase of the Great Depression. It was the Hoover administration then. Franklin Roosevelt came in 1933, and Roosevelt faced exactly the same problem. He shut every bank in America on his second or third day in office by executive order. He closed every bank in America. You can imagine the President of the United States today. I don't care if it's Biden or Trump or anybody else, Democrat or Republican, issuing an order saying every bank is closed as of now. We'll get back to you when they're going to reopen. And that's what FDR did to break the banking panic. But he still had the deflation problem, and the Fed couldn't do anything. I talked to Ben Bakke about this personally because Bakke wrote a book on this, and I read the book. I said, "Mr. Chairman, did I get this right?" He said, "Yeah, you understand it correctly." But the Fed couldn't and didn't do anything. So how did FDR break the back of deflation when the central banks were powerless? The answer is he raised the price of gold. He devalued the dollar against gold and raised the price of gold 75% from $20 an ounce to $35, and that worked. Because it wasn't about rewarding holders of gold. In fact, he had confiscated all the gold beforehand. So it's like insider trading. But the idea of raising the price of gold was really to devalue the dollar so you could get the price of corn, wheat, steel, get the price of everything else up. And it worked. In the middle of the Great Depression from 1933 to 1936, the market boomed. I mean, the economy did very well, but it was starting from such a low level, it was still depressed. But it did much better. The Democratic theme song was "Happy Days Are Here Again." Then in 1937, the Fed screwed it up again and caused a second recession in the Great Depression, and that's why they call it the Great Depression. But the devaluation of the dollar against gold worked. Nothing the central bank could do would work. Deflation is very troubling and should be to central bankers, economists and everyday citizens, everyday Americans, because it raises real interest rates really steeply. It feeds on itself and there's nothing central banks can do about it. And the only thing that has ever worked is devaluing the dollar against gold. So that's one reason to have gold. But we're looking at a global recession, and those are rare. As I said before, it's one thing if Germany has a recession, or Japan or the US, but usually there's another economy or economic group that's doing okay, or at least better, and can kind of pull everybody out of the rut. But global recessions where everybody's declining are rare, and that's what's happening. That's what we had in 2008, so the US is heading for one. We just talked about that at length. Japan's in a recession, Europe's in a recession, China's in a recession, India is having some tough times, and a lot of this is dollar-related. All the other countries I mentioned, Switzerland, India, China, Japan, have all seen their US dollar reserves go down. And everyone's like, oh, they hate the dollar, they're dumping the dollar. No, it's the opposite. They don't have enough dollars, so they're selling treasuries to get dollars to bail out their own banks because there's a dollar shortage. So the fact that you see those dollar reserves coming down does not mean that they hate the dollar. It means that they need dollars, that they're short of dollars, and they're so desperate that they are selling treasury securities to get dollars to bail out their own banking systems. So we're well on the way to a global recession. And if you say, well, you got communism, socialism, capitalism, all these different economic systems, all part of this globalized system, how could they all be on the same wavelength at the same time? Well, the common threat is the dollar. It's the US dollar. About 60% of global reserves, 80% of global payments. It's the benchmark for every other currency. So when you talk about the euro, you're quoting dollars. You're saying it's $1.05 or $1.04. Gold, you say, well, it's $1,800 an ounce, whatever. The point being, even when you're talking about a commodity or currency that's not a dollar per se, you reference it in dollars. Same with oil, world markets, all dollar-oriented. So the dollar is the threat that runs through the whole global system, and it's a partial explanation for why everything's falling apart at once. Now, what's the optimal asset allocation method? Well, the key is diversification. When you say diversification, people roll their eyes, go, oh, of course, everybody knows that diversification is good and all that. But the problem is they don't understand what diversification is. I run into people all the time and they go, Jim, I'm highly diversified. I own 50 different stocks in 10 different sectors: telecommunications, semiconductors, mines and minerals, consumer durables. So I'm highly diversified. And I say, no, you're not. You may have 50 stocks, but you have one asset class, which is stocks. And they're all going to go down together or go up together, as the case may be. But particularly in times of stress, they become highly correlated. So having 50 different stocks or ETFs or whatever is not diversification. That's just having a whole bunch of bets in one asset class. If you see value in this video, please like, share and subscribe. Now, what does real diversification look like? Well, you should have some 10-year treasury notes, or if they're a little too volatile for your taste, look at a 5-year note or a 2-year note. That will basically give you a very good, the credit secure. I'm not doubting the credit of the United States. But that will give you a deflation hedge if we get into disinflation and deflation where interest rates are coming down, which I do expect. You're going to get very good capital gains on those notes, or you're going to be very happy with the coupon in the meantime. Real estate, definitely. Not so much commercial real estate, too soon for that. But multifamily housing, residential real estate, farms, other kinds of income-producing real estate for a slice. Good slice of cash, maybe as much as 30%. People hate cash. They go, I don't get a yield on cash. Cash is a waste of my time, etc. It's true that it has a very low yield, but number one, it performs very well in deflation, which we talked about, but more importantly, cash is the opposite of leverage. It reduces the volatility of the rest of your portfolio. So if you have volatile investments in the wings, cash is like a bar connecting two ends of the barbell. It has very low volatility, but most importantly, it gives you optionality. If you see stock markets crashing and burning the way I expect, the way I described, the person with cash can go out and go shopping in the ruins. And by the way, Warren Buffett has over $130 billion in cash. Why does Buffett have so much cash? Well, he sees what I see. We're looking at the same thing, which is a kind of meltdown. The person with cash can basically go shopping for bargains. Definitely a slice of gold for the reasons we talked about. That'll be your inflation hedge, about 10%. People always say, gold bugs say, sell everything and buy gold. I've never said that. I don't think that's a good idea. But 10%, yes, that's a good slice. Private equity, if you can have access to good deals, that's a separate category. And so a model portfolio, you'd have a slice of treasury notes, a slice of cash. I'd have some stocks, but I would focus on, for example, energy, BP, ExxonMobil, Shell, Marathon. This green new scam thing, forget it, it's a big deal from a policy point of view, but it's infeasible. I've studied the science very closely, it's going to go away. But in the meantime, if you bash the oil and natural gas companies, but you're going to need the oil and natural gas, which we do, then those stocks are going to do well. Real estate I mentioned, and gold. So that would be a really diverse portfolio that would have 5 or 6 different asset classes, and some will outperform others. Some will do better in inflation, some will do better in disinflation. But that's the whole idea. With this much uncertainty, and your winners will help number your losers. And cash is like a thermostat. You can reduce cash and buy a little more gold, or reduce cash and buy a few more stocks if that's more in. So that's what I think an ideal portfolio looks like. Thank you for watching. Please subscribe for more videos.